What's going on, everyone? My name is Nicholas Merton here from Data Dash, and today is May 5th of 2023. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about the breaking price action that's been going on in both crypto and stocks following the recent FOMC meeting, and more importantly, talk about why the increase in volatility that we're seeing could lead towards a massive move or break in stocks and crypto over the next coming days. We've got a lot of things to talk about in today's video. If you guys happen to enjoy the rambling, consider dropping a like. It's one of the greatest ways you can support the channel. And let's go ahead and kick off the conversation. All right, I want to go ahead and start here by analyzing Bitcoin's price, because we are starting to see some really big warning signs. First off, we not only had a relatively weak or non-responsive move to the FOMC meeting for Bitcoin's price just the other day on May 2nd. But on top of that as well, we're already seeing continuously signs of our momentum indicator flipping between red and blue, showing inconsistencies in the trend with relatively weak price action, setting in lower highs since all the way back here in the middle part of April. So for a couple of weeks here, Bitcoin has continued the broader trend since back in mid-March of practically no trend, or at least in the short term, not making any acceleration on top of the previous trend that's been holding up since back in January. Now, I want to make something very clear here. While we are planning to short in the long term here over the next coming months, it's important to note that the bulls have not lost the trend. The weekly is still blue. We are still seeing a general uptrend in the grand scheme of things for the short term. Doesn't mean that this is going to be a long-term bull market. And with price action starting to stall here, this is going to make it more and more likely that this indicator could start to flip red and that the bears could take charge relatively soon. So again, keep that in mind. The only point I would say here is that as we go throughout the broader conversation, when it comes to the topic of shorting, it's important to note here, guys, that you not only don't want to go all in, you don't want to go with crazy amounts of leverage, but on top of that, that this could chop sideways in this channel. It's a relatively large price range from 28 to 32K, and it's a significant price range according to the last bull market. So don't be too shocked if this starts to prop up and maybe set in a new relative high here around 31, 32K. But the big thing we're looking for is when we get that trend flip. And you guys can track when that trend flips by utilizing the indicator that we share within the Dash report. Our blue-red indicator here for momentum is accessible to Dash report members, and we can help you get set up on that momentum indicator. But you can use it in all kinds of different markets, as it's a time-tested indicator well before even crypto markets. But putting that aside, let's go ahead and talk about the big topic here. In this month's edition of the Dash Report, we wrote about how Jerome Powell was going to come out and put the hammer down when it comes to Fed monetary policy. And to be honest with you guys, that's what we got in this meeting. We not only got that, but we got a lot of mixed signals that basically came to, I think, one very clear message that the Fed itself is willing to break things. They are willing to lead towards a couple of banks and other entities out there, even outside of the financial sector directly, to potentially break. And that is going to help try to get us back to that equilibrium of supply and demand, essentially curbing consumer confidence, leading inflationary pressures back down towards their 2% target, and essentially getting us into a state where the Fed no longer has to tighten monetary policy in the next couple of months to the year. If they really get this right, if they get ahead of the curve, if they're in the driver's seat and inflation is their number one priority, then we can get back into some normalcy. There were a lot of different comments that Jerome Powell stated in this meeting, but the biggest thing that stood out to me is what the Fed has stated time and time again. Not only that they raised the federal funds rate by 25 basis points, that's one that some people in the market didn't believe was going to happen, but on top of that, something that many people didn't expect is that the Fed is continuing its quantitative tightening program when it comes to its balance sheet. We talked about that in the last video. That was a big point to listen out for, and they are continuing that on autopilot. The banking collapse we saw in Silicon Valley Bank, in Signature Bank, and all these other regional banks like First Republic Bank is not enough for Jerome Powell to stop that tightening program. That is not something that is going to spur out further quantitative easing, at least not as of now. And that is a very clear signal to the market that the Fed is doing its job, that it wants to resolve this ahead of time rather than kicking the can down the road. But there is a third bigger point here. It comes back to the topic of interest rates. And that was that Jerome Powell basically stated that they are going to continue to remain data dependent and essentially continue to feel out month to month whether or not more interest rate hikes are going to be necessary. This is a major warning sign for markets, because it's not just a problem that the federal funds rate might go up another 25 basis points. Yeah, that's going to lead to more things breaking, and definitely it's going to be more difficult to raise capital or get loans in the economy. But all of that is kind of secondary. The big problem here is that there's uncertainty at the Fed, right? Or at least in the way that Jerome Powell is speaking here, that maybe we've got a much longer way to go in dealing with inflation. And this is what we've talked about here in the channel for a long period of time. It's why way back in the day when people thought, oh, the federal funds are at 2%, that's the max the Fed is going to take, maybe 3%. They can't go any further than that. We were stating 5%. That was our target, and we've now hit that with the Federal Reserve increasing the federal funds rate to where it is now. So this is something, again, as you guys may already know about, we have a newsletter here on the channel where we wrote about this month. We talked about how Jerome Powell had actually pretty much given us the play sheet for the Federal Reserve as far back as January through a leaked call that came out. Again, if you guys want to read into that article and see what we wrote about, you guys can definitely do so at the link down below in the description. You'll get access as well to our momentum indicators, trade alerts, all kinds of good stuff. And if you sign up for the newsletter, you'll get it at a 20% discount if you sign up annually. It's a great way to support the channel, and it's a great way to get kind of deeper into these topics and learn about where we come up with the thesis we present here on the channel, as well as our actionable trades to really profit. We've made some serious moves here over the past few days. We just made a trade back the other day in a leading technology stock to the downside, so we're shorting. So if you guys want to get access to those trades, feel free to check out the link down below in the description. But we're basically putting our money where our mouth is here, guys. We believe that the Fed is going to have to continue tightening. It'll take us right back to where we were back in February when it comes to the balance sheet, and the Federal Reserve is likely going to continue to keep interest rates at a heightened rate, even if it means things are going to break in the economy. There's another big point he talked about, that the rates were likely going to have to stay suspended for a much longer period of time than markets are pricing in. All right. So this is a really big dynamic to talk about here. And the reason why it is absolutely essential to realize just how damning this is for markets is when we take a look at what's going on in the banking sector. Jerome Powell got relatively criticized by a lot of market participants or those watching the FOMC meeting when he said that the banking system is strong and resilient. He said that yesterday during the FOMC meeting with a straight face. At the same time, when the day afterwards, PacWest Bancorp, a large regional bank in California, drops 50% in its share values after already declining a massive amount since back in February and March, from around $28 to $30 a share all the way down to $3 a share, losing 90% of its value in the process and pretty much setting itself on the course similar to First Republic Bank and Signature, as well as Silicon Valley Bank. And it's not just PacWest, guys. There's also Western Alliance Bank Corporation, another regional bank, down 38%, originally trading at $81 a share back in February, and yesterday trading at a low of 12, closing at 18. This is not a good sign for the broader banking sector. And we're also seeing the larger banker plays as well, like JP Morgan, that should be benefiting from this decrease in banking competition and consolidation and potential acquisition opportunities. JP Morgan is also trading lower as well. All of these stocks are feeling the pain. IAT, which is the regional bank ETF, dropped another 5% yesterday. That is down essentially from February, from $53.50 per share down towards $29.75. It is an absolute bloodbath. Now, I want to make something very clear here. I think that the regional banks are getting relatively close to a bottom. I think we are going to find that at around $22 per share, or around $22 to $23 per share, basically from when we were last speaking about it, or we can, I guess, kind of adjust it to where we are now, about a 25% decline from where we are now in regional banks before we really find a bottom. That's in line with previous lines of descending support that could serve as a foundation for some kind of rebound in these stocks, for some of these banks to be acquired. Some of them may not be fairly priced at the moment. Some of them might be more resilient or able to stomach the situation. And I want to make it very clear by making this claim here, I'm not stating that the regional banks are absolutely doing fine and they're doing great, but there's also not going to be this massive bank run in the system collapsing, as a lot of people are starting to price in. And if that's the scenario, it means basically two things. One, that Bitcoin is not going to be this saving grace asset that everyone rushes to. We've seen within stablecoin liquidity and real actual market order flow metrics that this just isn't the case. The price action alone is telling us this. Basically this entire Bitcoin $1 million price target prediction completely fell through and now is being labeled as a marketing campaign for Bitcoin. It did nothing of the sort. It just got a lot of people to FOMO into Bitcoin and put a lot of capital on the retail trading side in at heightened prices for Bitcoin. It does not show any sign of institutional capital. There's hundreds of billions of dollars moving from First Republic Bank, withdrawing in a bank run. They're not going to Bitcoin. We do not see it reflecting the price action. On the other hand, though, what we are seeing is a liquidity contraction and continued bank runs on local banks. And that is going to set a really negative tone here for the entire financial system. Because if regional banks stop lending, these are the companies, the banks, mind you, that are providing consumer credit, they're providing business loans that really stimulate a lot of economic activity. When this happens, they are going to have to essentially take their position, which is that a lot of these banks have a lot of mortgage-backed securities. They have a lot of fixed income products. Essentially, because those are time-locked, that they aren't available, and that there are these bank runs going on, banks are pretty much forced to do one thing. And it's something that's going to crush a lot of their profitability. And that's stopping lending activity, lowering the amount of credit cards, lowering the amount of consumer mortgages and other types of loans, auto loans, things that stimulate, create credit, and generate economic activity. They are unfortunately going to have to stall this. And this is going to be the first major domino. And I think we're going to see it also in larger banks as well, like JP Morgan, all these players, Bank of America, Wells Fargo. That consumer credit activity is going to come to a halt. And if you've taken a look at the data for how important credit card use is, even in this high interest rate environment, how important credit has been in continuing to keep the economy afloat, you'll realize just how damning this is going to be when it comes to the demand side equation. This is what the Fed needed to do in order to tame inflation. And it will start to reflect over the next couple of months. But the important thing to understand here is that things are going to break, and it is going to leave a lasting impact. It's going to leave us in a recession, which is what unfortunately we have to go through before we can really start to move higher. Take a look here at what's going on in the stock market. S&P 500 here over the last couple of days has had three consistent red moves to the downside, essentially speaking nearly 3% to the downside here over the past few days. The Dow Jones as well, 3 consecutive red candle days here that we're seeing within prices, down basically another 2.6%. And we also have the NASDAQ as well, trading down, roughly speaking, nearly 2%. And to make matters worse, the small caps, the Russell 2000, down roughly from 1766 points down to 1700, about a 3% move to the downside. Now, the daily time frame doesn't look quite optimal here, but I want you to go ahead and again step back into the long-term time frames, guys. I'm not here to be doom and gloom here on certain percentage moves here on a daily time frame. Same as I wouldn't be telling you to FOMO in off of some moves if prices moved up slightly during the FOMC meeting. What I want you to take a look at is the monthly time frame. And I want you all to look at our momentum indicator, I want you to look at price, and I want you to think for yourself here whether or not you're going to agree or disagree with me here. I just want you to take a look at the long-term time frames, because so many people will not show you guys these charts because they think you only want to see the short term. But for many of you who are looking to buy in for the next bull market, take a look at these indicators. Right? This is the index, the Russell 2000 small cap index. No blue flip since all the way back in February where we flipped to red. 4 consecutive months of moves to the downside. Now, perhaps maybe the Russell 2000 is an anomaly here, right? Some may see this as a bullish chart. I gotta be honest with you guys, this looks bearish to me. This does not look like the start of a new bull market. This looks like chop. And chop is not something I want to buy long-term positions into. The NASDAQ has been continuing to ride in a long-term accumulation channel, but for multiple months, unlike the previous times in the past, it has not been able to escape this channel. The momentum indicator is still red. So take a look at that chart. Let me know whether or not you feel that that is the start of a new bull market. Is it really time for us to start moving to new all-time highs in the near term? Is the AI narrative enough to carry forward the value and technology stocks here that we've built up over the last decade. Our quarterly earnings really putting us in a position, the fundamentals, to be able to sustain this rally long term. Let's take a look at the Dow Jones here. One of the saving graces that actually had a blue flip on the monthly time frame, showing time and time again blue, red, blue, red, blue, red flip here with lower highs when it comes to price action over the past couple of months since back during the start of the year. And the S&P 500, right, which again was one of the more resilient indices, still holding down since where we were back in May, not able to set in a new high monthly close, with the momentum indicator still red and flat. I'm going to zoom out here real quick, even further, guys. And I want you to tell me, right? Take a look at all those previous kind of bear market corrections that we had along the way, right? What does this look like to you? Does this look like a short-term correction in our secular bull run where the Fed's just going to come to the rescue? Or does this look like the beginning of the domino effect that starts a substantial recession or depression? I think we are seeing the latter play out here. We are seeing a typical recession or depression, bear market that comes around every decade or so and is going to lead towards a 40-50% correction in price and valuations. That's the name of the game here, guys. And if we take a look at the VIX and what we've seen over the past few days, it looks like something has broken here, or at least the market is starting to get very uncertain about how far the Fed is really willing to go. Now, we have to remember here that markets have been pricing in that the Fed is not going to tighten as much as it claims it's going to do. But if we take a look at price action when it comes to the market, it's starting to realize that perhaps it's optimistic over exuberance, perhaps was pricing in too much optimism versus the reality. And this is why we need to get prepared for a major move to the downside. The VIX spiking up here to its highest level since late March is definitely a sign that we need to be concerned here, especially at the accelerated pace. Now, there are a lot of other different things that we need to keep in mind here. The first one is the broader financial sector. XLF ETF, which is one of the best measurements for the broader financial sector, after setting in new highs for about a year or so during this period of time in 2022, has now started to falter here with lower highs and lower lows. It is holding by a thread at a significant range, around 30-50 on ETF, which was the previous highs back in 2007. If that level is broken, you are very well looking at a potential correction down to 17.5 on the ETF. That's more than a 50% correction from the previous all-time highs. And that's where we found our lows in March of 2020 and found our support range back during 2014 to 2016. I think this is a relatively reasonable area to look for. And you don't have to wait until we get all the way down there or until we deviate below that range, right, for lower prices. All I'm saying is it's probably best to wait until we get towards some range like here, somewhere in the middle, before you really start to do your dollar cost averaging, before you start really going long on Bitcoin and a lot of risk on assets, historically speaking. I love crypto as much as the next guy. I think crypto has a valuable place in the world as being a hedge against government currencies, potentially becoming a store of value long term. I get it. But it accelerated most during a period of time when the printing was actually happening. We are not seeing monetary printing now. We are seeing contractionary actions. We are seeing tightening monetary policy. And it's important to note, one last chart I want to talk about here is what's going on with oil prices, right? Yesterday was looking like it might be the day. Might be the day oil finally snaps against the 200-week. The 200-week moving average has been support time and time again. And unfortunately yesterday, we got to bounce right back in. And now it's back in the pocket between the 200-week and the 200-week EMA. If this accelerates back up above there and keeps holding higher, the Fed has not done its job yet. It is not done. Until we really see a substantial breakdown and a continued trend below the 200-week for oil, inflation will continue to be sticky. And it will show that consumer demand has not cooled down enough. Liquidity has not been absorbed just enough just yet. So this is really what I keep coming back to, guys, when I talk about the total crypto market, with crypto valuations at $1.16 trillion. If we minus stablecoin liquidity, it's probably somewhere around $1 trillion in market cap. Pretty decent size still for this market, this alternative market, with very few real use cases outside of potentially being a store of value. Let's be real about it, guys. DeFi activity has really fallen off a cliff over the past few months. I mean, what other narratives? NFTs? Governance? I mean, what kind of use cases are there that we can really get excited about right now? Now, I think above all of those, DeFi is definitely a really interesting topic. But if we take a look across the major DeFi tokens like Uniswap, Aave, Compound, Curve, and Maker, these are the 5 largest when it comes to the Ethereum ecosystem. When we're talking about purely DeFi projects, a lot of them have been stagnant. A lot of them have been bleeding here over the past year, and really the past year and a half since we had our bull market peak. Down roughly right now about 82%, with the relative lows being 87% back in June. So what's the problem here? The problem here is that we're not only in a contractionary environment, but the problem is with these plays is that they're set by the bottlenecks of the Ethereum network. The Ethereum network, the core technology we've relied on for so long, is stagnant. It is not progressing at a fast enough rate. It has technological issues that are going to continue to set back Ethereum and the development in Solidity-based programming languages. But I want to go ahead and try to tell you all about something that I'm really excited about. I want to spend some time to talk about something that may be able to buck this trend. And that's our long-term partner here on the channel, Radix. Now, if you guys have not heard about Radix just yet, Radix as a protocol is aiming to radically rethink the way we conduct DeFi applications and how users interact with those applications. Through utilizing scripto, blueprints, and asset-oriented language, and the ability for people to be able to streamline thousands upon millions of transactions on one single distributed ledger technology, this is where Radix really starts to stand out, rapidly simplifying developer time to build applications as well as manage the security around those applications, but also through that being able to build applications we just simply haven't seen in the DeFi ecosystem. A big reason why Uni, Compound, Aave, all these assets have been relatively stagnant is because it's incredibly difficult to build within Solidity, the native programming language on the Ethereum virtual machine. And once more, we constantly see people who are using that framework just copying the same old DeFi applications on some scalable network. Building a scalable chain is not going to save these applications. It's not a problem of scalability, it's a problem of functionality and a lack of creativity in the kind of applications people are building. This is why DeFi has been stuck at its previous peak of around $150 billion in TVL and has been dwindling ever since. Radix, on the other hand, is aiming to change this in a big way. And they're aiming to do this by offering a much more dramatically simplified developer experience. And the Radix DeFi ecosystem, for being a relatively new layer 1 when it comes to having access to these developer tools, is already seeing a broad ecosystem coming to the forefront. People have already built a lot of the core infrastructure for DEXs, as well as lending protocols, insurance, as well as portfolio management and yield farming tools. And people are also working on oracles and other core infrastructure for use cases like NFTs. So if you guys want to dive into the budding ecosystem around Radix, I highly recommend you guys check it out. There's a lot of people building the ecosystem. There's a lot of grant programs and developer incentives to get people involved and participating. And people are building some really exciting stuff that's been being built behind the scenes. So it's incredible to think about how much is already being built here in a bear market when it comes to Radix. And I think it's only going to be accelerating as we go forward. Now, the big thing I want you guys to know about here is why Radix is such a big game changer. If you go through, I highly recommend you guys dive into this section within the website where they basically go through and talking about the game engine for DeFi. The idea here is if you can build something that radically simplifies the way applications are built, it's going to allow for much more prosperity when it comes to the types of applications we have access to. There's a framework to be able to scale use of those applications, maintaining atomic composability, and allowing you essentially to not only do all the things that you originally did within the Ethereum ecosystem, but on top of that, being able to do entirely new things. This is going to take us from that $150 billion TVL that we previously saw in DeFi that has now been stagnated, all the way up to potentially $1 trillion or more, getting real traditional financial service providers integrated into the ecosystem, major investors, hedge funds, market participants, and banks starting to actually utilize distributed ledger technology. It's going to allow for safer assets and better dApps, allowing for us to get away from the $1 billion plus each year that's lost to hacks and smart contract exploits. It's going to allow us to see faster time for developers to move into the crypto space, not having to learn Solidity, which is a very blocky, difficult language, and instead learning how to utilize an asset-oriented language like Radix that's going to allow people to build smart contracts in a much simpler fashion. A great example of this is when in the Radix ecosystem, Russell, who's the CTO of Radix, demonstrated through RadixSwap how you can build an automated market maker like Uniswap, which Uniswap v2 took thousands upon thousands of lines of code into less than 200 lines of code. This is a great example of how you can dramatically simplify through Scripto, which is based off the Rust framework. You can dramatically simplify developer applications within the Radix ecosystem versus Ethereum. And of course, composability. This is a massive portion of the topic of scalability. Problem with Ethereum and a lot of its solutions towards scalability may very well be the composability issue that has continued to persist. And while there are some advancements and technologies like Layer 0, as well as some other potential side technologies, as well as the upgrades and the idea of eventually having sharding on the Ethereum network is one of the major upgrades, all of this is still a bit distant in the future. We have to see whether or not it's actually going to hold up. Now, if you guys haven't already, at a minimum, I highly recommend you guys go ahead and follow them on Twitter. If you aren't following Radix already to keep up to date with some of the major updates, I highly recommend you guys join the Telegram or Discord channel if you're interested in becoming a market participant in the Radix ecosystem. But more importantly, for those of you out there who are developers, I highly recommend you guys check out the documentation around Scripto as a language and see if you can build some really exciting applications. So long as you have the creative ingenuity to build something that you haven't seen within the DeFi ecosystem, if you're passionate about DeFi, Radix itself could be the network where you can really express that freedom and catch the momentum early on in a really exciting network as the continued iterations of the network deploy over the next few months, allowing for full smart contract capabilities and for real value creation to really materialize within the Radix ecosystem. It's a perfect time to start building. Yesterday was the best day to get started, but today is also a good day. And it's best to go ahead and check out the documentation and see if it's something that interests you. And if you're not so much a developer, you're not really interested in that, definitely check out the various white papers on Cerberus, the consensus mechanism, as well as Scripto and some of the other parts that make Radix such an exciting network. But I've rambled a good amount here. You guys can check out the links down below in the description. And as you guys join the ecosystem, let them know the Data Dash brought you there and stuff. It's a really exciting network. It's one of the few networks I'm really actually excited about, specifically when it comes to emerging layer ones. It's one of the few that I actually feel has the momentum among so many other players in the market to topple against Ethereum. And we're really happy to have them as a partner here on the channel. But that's it for today's video, guys. Thank you all so much for watching. If you guys happen to enjoy this video, consider dropping a like. It's one of the greatest ways you can support the channel. You can also check out the dashboard down below in the description. But until the next video, everyone, thank you all so much for watching, and I'll see you all in the next one. Stay safe, trade smart. I'll see you all in the next video.